Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Hello, and welcome to another episode of A Canadian Investing in the U.S. This week I decided to take a week off and instead introduce you to my other podcast again called Advanced Real Estate Investing Talk. I picked out another one of my favorite episodes, so hopefully you guys like this one. And if you do like it, maybe go over and check out that show as well with Ari and Darcy and myself.
Welcome everybody for a new episode of the Advanced Real Estate Talk. It's Aurélien. I'm here with Darcy and Glenn, and today we'll be discussing how people invest in a context where cap rates are so compressed and it's not getting any better. So let's dive into it. Darcy, would you like to get us going?
Yeah. This is, when you see, it's a bit discouraging when you see the expense of buildings or properties going up and up and you think you can never chase them. The only encouraging thing about it is that in where the cap rate, and I recognize some listeners may not know about a cap rate. Maybe we have to back up a bit.
Sure.
In a compressed cap rate, when the cap rate is low, you're actually dividing a smaller number into a bigger number. And that's kind of a good thing for making wealth. If your cap rate, and a cap rate is just a way to average or to compare two disparate properties. You have a 4-plex and a 10-plex. They're not anything similar. They have different numbers, but if you divide a constant into their net income, you can get a comparison. So when the constant, the cap rate, and that's the capitalization rate, when that constant gets smaller and smaller, you're dividing a smaller and smaller number into the big number, which is your net income. That means the value is going up. The product of that division is the value of the property. So, cap rates maybe 10 years ago sat around 6.5% in urban centers, 7% in the hinterland and tertiary markets, maybe 7.5%, 8%. But right now in Vancouver, I'm looking at stuff that is 1.5, 2.3, maybe 3 is a decent cap rate in South Vancouver and some of these apartment buildings in Marpole. East Vancouver, 3.1, 2.9. That is a tiny number. And if you divide a number like 2.1 into say 200,000, let's see, a net income of $100,000. You're getting a valuation of about 4.1 million. That's an incredible, and that would be for a 10-unit building, 4.1 million or higher. A bigger cap rate is dividing a bigger number into that big number, you're coming up with a lower valuation. So when the cap rates compress, when they keep going down, what it means is that the market is telling you that they still see value in that property and they're willing to take a lesser return. They're going to pay more money. So instead of paying $2 million for a building with a $200,000 return, they're willing to pay $4.1 million for that building. And when they compare it to other markets, they're good with that. But what it does mean is the building is twice as expensive and you're still getting the same return. Nothing has changed in the operations of the building. It's just twice as expensive. That's a lot of difference. And that's what's happening in Toronto, Kitchener, Waterloo, Cambridge, London, Vancouver, and to a lesser extent, some of the secondary markets like Ottawa, Calgary, Edmonton, even places like St. John, New Brunswick. I'm looking at 3 plexes and 4 plexes there for a friend, and they've doubled in the last 2 years. Why? Well, I got lots of theories on that, but in a compressed cap rate, so when we're talking compressed, where it's falling from 6.5 to 5 to 4.5 to 3, it means the building's more expensive. But here's the real great trick. And I have to say that my nephew, Jason Eidenberg, pointed this out to me when I was complaining about it. He said, yeah, but any improvement that you make to that building operations has a really big return.
Yeah. You
reduce your water. So for instance, this is a classic one. You got to keep this in your pocket. This might be gold for anybody listening. Back in the 70s and 60s, when these buildings were built, water wasn't metered. It was free. Water's free. Everyone thought everything was free back in the 60s and 70s. They would put in a 2-inch water service from the city because just in case, what if you need more water? They put in a 2-inch service because 2-inch pipe is easier to work with than 1-inch. So they put in a 2-inch service. At some point, the city started putting meters on these and said, we should meter buildings. So they put a meter on a 2-inch service. And then some point later, they started charging for it. And there's a meter ticking over every cubic meter of water that you get into your building coming through a 2-inch service, goes to the meter and you pay for it. So at some point, someone in the city said, well, what do we charge for these meters? Well, let's see, a 1.5-inch meter, $300 a month. How much for a 2-inch meter? $600, right? Do you need a 2-inch water line coming into your building? Actually, no. You need 1.5 inches. The difference is $300 per month charge on just the meter. It's completely arbitrary. It's not because you need it. If you step that down to a 1.5-inch meter and distribute the rest of your buildings at 1.5-inch water lines, if you step that down, you'd pay half the metering cost. And there's a trick. Just because they can't tell how much you flush your toilets and how much water goes back into the sewer, they charge you the same amount in as out. They assume zero loss and no water is being carried off site by humans. They just figure zero loss, $300 in, $300 out. However, if you step that down, or sorry, 600 from a 2-inch, if you step that down to 1.5 inches, it's 300 in, 300 out. You've cut your costs in half. What that means is that $300 that you save each direction times 12 months is $7,200 a year. That's quite a bit of savings. That's huge.
And it goes right to your net operating income, and apply that to a cap rate for us.
Okay, so imagine a cap rate, $7,200 a year to a cap rate divided by 0.065. 7,200 divided by 0.065. You've added $110,000 of building value to sell the building after doing that one thing at a 6.5 cap. However, $7,200 in, say, Edmonton, where you're looking at a 4.3 cap, you added $309,000 to your building value, tripled it. It's that important. So anytime you give a rent increase, so you think, I'm not going to give it this year, a $15 rent increase on 30 units or a $50 rent increase on that many units, $1,500 a month, you add that up, that's a lot, especially in a compressed cap. You cannot take rent, you cannot forego rent increases unless you really have a good reason. Your expenses are going up. All these little things, reducing water, any sort of efficiency in a low cap environment is money. It is gold. You have to be on top of this stuff. That's how you extract, value out of your building. And it works in both operating cash flow, and it also works in your building value of equity. You have to do it. Any other thoughts on that? Sorry, I talked probably for 6 minutes, but.
Well, you covered something very important. Yeah.
Yeah.
The benefits of low cap rates, actually. That's very interesting.
Mm-hmm. Yeah.
Glenn, what are your thoughts?
Well, when you talk about exactly what he said, you can apply the same thing to single family, right? It doesn't have the cap rate, but when he was talking about the rent, right? So a lot of people I don't want to do the rent increase, right? So I just made up some quick numbers, right? So say you had a property that rented for say $1,000 a month. If you did a rent raise of 3%, which is completely reasonable in most markets in the US, at least you're allowed to do that. I know you can't do that in Ontario, but that would only be like a $30 raise. And a lot of people don't do the raise because it's only $30, right? But say that property was cash flowing, we'll say $200, depending what kind of market you're in. So it could be $500. But anyway, we're counting mortgage and everything in there. Say it was $200 and you went from $200 to $230 a month. If you think about your cash flow percentages, you've done a 15% raise to your cash flow. Just think about that, just with that little, because it all compounds, it's all leveraged, right? So with all these leverage things, everything has a multiplier to it, right? And that's exactly what Darcy was saying, only with the cap rate, but it does apply to single family as well. So with me, I went a little bit different direction when I was thinking about this, when you're talking about how to invest in compressed cap rates, right? And a lot of it comes down to rent to value. As the values of these properties go up at these extraordinary percentages, the rent doesn't go up at the same percentages, right? No. So what happens is, I think I've talked about this a million times, but if you're talking about the 1% rule on a $100,000 house, it should rent for $1,000 a month, right? But $1 million house doesn't rent for $10,000 a month, right? It just doesn't happen, right? So, and as you go lower, it goes on the other side. So you get like a $30,000 house, which, with the 1% rule should be $300 a month, but it doesn't. It's the other side of the coin. It'll rent for like $600 or $700 or $800 a month, depending on where you are and what the market is, right? So what happens with, at least with me, is how I invest as this keeps getting compressed and these things still appreciate. If you still want to buy, I've changed markets. I've moved markets. I was originally in Ontario, and I sold my properties in Ontario and I moved it to Alabama. And then Alabama appreciated a lot, and it got the like per cap rate, or like the values of the houses went way up. And so I moved to different markets: Missouri, Indianapolis, Ohio, right? So I was in Dayton and Toledo, and it what I did was I found a place that it would work, right? So that I could still get the numbers I wanted. And what was actually kind of cool is whenever I was selling my properties in Ontario, I could sell one and buy four in Alabama. And now that Alabama has exploded, I was selling four of those, or selling one of those, and I could buy four in Ohio. And so when you think about it, that's a 16-1 from Ontario to buying in Ohio, right? And and you're still using the same amount of money, and there's a lot of that's a good bump, right? So anyway, what it's come down to is looking a lot harder and finding the markets that work, right? And the same things happened in Florida. I've invested there, and it's appreciating a lot, and it's getting more difficult. But the middle of the U.S. is a little bit easier. I think the same thing probably with certain markets in Canada, right? You can, like, I know, Darcy, you're in Saskatchewan. Am I right there?
That's right. Yep.
Yeah.
In Northern Alberta. Yep.
Yeah. But you hear people going investing in Saskatchewan, Nova Scotia, New Brunswick, and they move their money to markets that they can get the numbers that they're looking for, right? Because everyone ideally has investing goals. And that's really what I've done, is instead of trying to fight this, I've just moved to places that work easier. Low hanging fruit, less resistance. Yeah. What about you, Ari?
Yeah, that's interesting. That's also a direction I took my my thinking and my remarks. Yeah, it's pretty obvious that multifamily has really seen a lot of compression in the past years. There is lots of courses to become a syndicator, and there is a lot of everybody wants to retire and become a real estate investor, and so multifamily has seen a big compression in cap rates. So has industrial, and yeah, so you can leverage information asymmetry to try and find deals and buy in contexts that are not either you could try to buy those properties off market. You try to avoid betting wars, so as not to pay, not to overpay, and like Darcy was saying, an increase, an NOI is going to translate into he's going to go way further with a lower cap rate. So that's been covered. But for myself, I've expanded a little bit my horizon, and I started looking at other asset classes. It's been a year already. And when I was working at this foundation, and they knew about real estate, and they recommended from the get-go that I look into a commercial. And so this is what I've done. So I created this Facebook group, and we have also a meetup group that focuses on commercial, because you can find some asset classes that have cap rates that are still okay. And the same, like Glenn was saying, looking in different areas of the country, different areas in the US. Yeah, so for myself, I'm starting to look at other asset classes. Educating myself, is the first step. Creating a group around myself of people, interested in the same topics, and yeah, so and maybe I'll pull the trigger at some point with fellow investors and in one of those other asset classes within commercial real estate. Not necessarily multifamily, not necessarily industrial, but yeah, these are my.
Well, you were talking about development, right?
Mm-hmm.
Yeah.
And I think that compressed cap is probably happening in all sectors. It's moving. When I was thinking, when Glenn was talking, the comparisons, and I was talking the comparisons, the commonality between our different areas of focus, is that these cap rates, or what we're talking about, compressed cap, it's a ratio. It's between this and that. A cap rate standing on its own is a meaningless number. It's compared to what? It's always compared to what? It's a ratio. So if someone says, what's the cap rate? It's, for what class and compared to what? What are you looking for? It's important to keep that in mind, that it's between two products. It's used to compare this and that. That's an important thing, that it's a comparison. It's a ratio between items. A second one, money thought here, is what Glenn and Ari and I are all describing, is that money doesn't have agency in itself. It doesn't have a mind or a will of its own. But if you pay attention, investors do, and money indicates where it flows to. And you can see money will go to, it's very efficient. It will go to where returns are. And a cap rate is one of those things that's an indicator of where money is going. What do people think is valuable? So right now, the rest of the country is seeing what Toronto and Vancouver have said for the last 10 years. The value of real estate is it's never been higher. Every year it gets higher, of course, by a little bit of inflation. But I think people are appreciating the value of underlying real estate, the value of land in this country. You might think it's a big, big country, but a lot of it's not serviced and not available. And land that is serviced and available for human habitation and growth and urban stuff, activity, is actually quite constrained. So the underlying value of land, if you're looking for comparables, and this is my soapbox now, try Zurich, Singapore. If you're talking for a comparable for Vancouver, try Singapore, because Vancouver is an island between mountains and the US border. It's like Singapore, or the island of Hong Kong as a comparison for Vancouver. And if people keep thinking that it's going to go down, has it gone down in Singapore? Has it gone down in Monaco? Has it gone down in any of these sort of small locations? Do I think there's a bubble in Vancouver? Maybe it's superheated. Maybe it's a little bit ahead of the rate. I don't think so at all. I don't think it's going down in Vancouver at all. So the good thing about a compressed cap in some places where our investors are, say in the GTA or in Vancouver, is that their properties are compressing and growing in value, and money will flow, like Glenn has described, into Alabama, into Florida, into Ohio, into other neighborhoods where there's higher cap rates or opportunities. So
it could just be a few years behind of these other markets.
Yep, it always is. And you'll see them, you'll just watch where the money's flowing to. If you pay attention to CMHC or newspaper articles, or get your eye on a national journal. I don't pay attention to the US stuff, but the Canadian stuff is indicative. You can see where money is flowing and what it's doing. You can see money is flowing into Bitcoin and other products. My focus is on real estate, so I watch carefully where money is flowing in real estate and compare using cap rates.
You talk about like Singapore as an island, and there's no more room to grow, and that's what force is. Like you run out of land, right?
Yep.
And so there is a whole bunch of things besides that, like you mentioned with BC, with the water and the mountains. It blocks it in to create basically a virtual island. But these virtual islands, I'm using quotation marks because people can't see us, but they are showing up all over the place. And it's things that sometimes it's neighboring counties or that won't allow building, right? So you look at the Waterloo region, like Kitchener, Waterloo, Cambridge, and the regions around it, or the counties around it, won't allow them to expand anymore.
Yeah.
So they've created islands. If you go over into Milton and areas there, the greenbelt, that this government greenbelt that it's forced lines that they can't go any farther. And so then we're getting denser, and we're going to tear down old buildings and build new ones. We're going to go into Waterloo, and we're going to tear down a whole road and build a skyscraper because it's just getting dense.
Yeah. And that's part of the thing that's driving prices up and value of land values. We want to preserve wetlands. We need agricultural land reserves in BC here in the Fraser Valley. There's land that's set aside for all of these purposes: to restrain water, to maintain habitat, to provide food security. It's reluctantly being turned into housing. There's going to be more densification. With densification, it's going to lower the cap rates. Each piece of land is going to produce more income. Therefore, it's more valuable. Then you could accept a lower cap rate for the value that's going on. That's all that's happening. It's just urban geography 102, 103. That's
Take
good.
us home. Take us home, Ari.
Yeah, thank you everybody for tuning in. So yeah, there was a discussion for today, how to invest in compressed cap rates and the good side and what the future reserves. And looking forward to seeing you all next week. And if you have any question you'd like us to tackle or handle or discuss during the show, feel free to email it to us at advancedreit
Talk.
advancedreit@gmail.com, and it's advancedreit@gmail.com, and it will be our pleasure to cover it for you. Thank you.
Yeah. Thanks,
Buy real estate and wait.
That's good.